Hi, I'm Suneel Maheshwari, Professor of Accounting at Indiana University of Pennsylvania. Today we'll be talking about deferred income taxes, how to account for those deferred income taxes. Now, the deferred income taxes arises because the measurement of income under GAAP rules and the IRS rules is different. So deferred taxes arises because in the accounting GAAP, or when you compute the accounting income, it is computed based upon the principles designed by the accounting profession or FASB. And as far as the tax rules, tax income is concerned, it is based upon the IRS principles which are designed to collect income taxes. So when we compute the taxable income under GAAP or under IRS rules, there might be a discrepancy or a difference between these two incomes. The difference between these two incomes could be a temporary difference or it could be a permanent difference. Temporary differences can be resolved over a period of time. So just as the period time passes, the temporary differences will basically wash over. For example, there might be revenues which according to GAAP are not taxable by IRS until the payments have been received. Or on the other hand, you might have expenses in the GAAP that are not deductible according to the IRS until they have been actually paid. So in some of the cases, you will see that IRS will not allow certain expenses to be deducted unless and until they're actually paid. But under GAAP, because of the accrual accounting, you might have incurred those expenses. Now, how do we resolve the temporary difference? To resolve the temporary difference, we will look at the pre-tax income according to GAAP. Then we compute the taxable income as per the rules and regulations of Internal Revenue Services. Also determine the tax expenses as per both, which is GAAP and IRS. And finally, we will make necessary journal entries on those differences. When there is a difference and that difference leads to a higher tax payment in the future, that is basically referred to as a deferred tax liability. In case the difference will lead to a future cash flow saving due to the taxes, it will be referred to as deferred tax asset. So any temporary difference that in reversing itself will cause the taxable income to be lower than the financial income primarily. Let's look at an example. A business has $250,000 in business income, $100,000 of accounts receivable, and $120,000 of business expenses with a tax bracket of 30%. Now, as per the IRS, account receivables are not taxable until collected. But in GAAP, the revenue is recognized when the sales is made, even though it is an account receivable. So in this particular example, if we compute the income and expenses as per the two methods, then it would appear as follows. You've got the revenue, which is $250,000, expenses at $120,000. But if you look at the IRS income, it does not recognize the receivable, so the taxable revenue is only $150,000, although the expenses are $120,000. So the taxable income under IRS rules is just $30,000 as opposed to $130,000 under GAAP. And at a 30% tax bracket, the tax under GAAP would be $39,000 and taxes payable under IRS will be $9,000. Now you see the difference between $9,000 and the $39,000. And that $30,000 will basically reverse over a period of time. So those taxes are deferred to the future and will be paid over next few years or next year when those receivables are collected. So the journal entry based upon the computation that has been done, under GAAP, your income tax expense was $39,000 as we computed. And then income taxes payable are $9,000. That will be credited. And we create a deferred tax liability of $30,000. And this $30,000 will be eventually due when receivables are collected. And in this way, that's why we call this a deferred tax liability, because this will become due in the future when the account receivables are collected. Now, the permanent differences in the two income can be due to various reasons, but these differences will not be resolved over time, and that's why they are called permanent differences. There is no calculation or journal entry needed for resolving these permanent differences. What are the examples? Examples will be fines and penalties that are paid by businesses, which are not considered as deductible. Or if the company has invested in the tax-free bonds, say municipal bonds or any other tax-free bond, the interest on that is also tax exempt. Now, business is not subject to taxes on operating losses. So as opposed to an individual, where an individual has to pay the taxes on the earned income, the business, if the business gets into losses, it does not have to pay income on those losses. And also, if there is a business loss, then that can be offset later on. In net operating losses can be carried back for 2 years and carried forward up to 20 years. So you want to apply the carry back losses must be applied first and then the carry forward. Because if you don't apply the carry back losses, it cannot be applied in the later years. Let's take an example. Behram Company has a net income of $100,000 in 2012 and $200,000 in 2013. In 2014, Behram Company has a loss of $500,000. Tax rate is 30%. Now, since we had net income of $100,000 and $200,000 in the previous 2 years, we can carry back the losses against those $300,000 at the rate of 30%. So primarily $30,000 of loss or there'll be a tax saving of about $30,000 when you offset that loss of $100,000, and then there'll be a saving of $60,000 when you carry back the loss of against the $200,000 which was paid earlier. So you will basically save $60,000 plus $90,000 in the tax savings. So we still have about $200,000 of loss. As out of $500,000, we offset $100,000 and $200,000 against the last 2 years of gains, and $200,000 of loss can still be carried forward up till next 20 years. And when the loss is carried forward, basically there is a tax saving on those losses to the extent of $150,000. That is 30% of $500,000. Well, this concludes our session on the deferred taxes and how to account for the deferred taxes. And thank you very much for listening, and see you soon again. Thank you.